Hello all, welcome to the Dr. B.R. Ambedkar Open University classes. Today topic is cost of capital. Okay, unit number 8. Here in this unit we are going to learn meaning and importance and the factors determine the cost of the capital. Then problems with the determination of the cost of the capital and weighted average capital and methods for evaluating the cost of the capital. Introduction. Okay, first, why we need to calculate the cost of the capital. When the company getting the funds from the outside and utilizing that funds in the business, after utilization the company should get the minimum return on that funds. In case if the company failure to generate the minimum cut-off rate on its capital expenditure, this maybe leads to the problem. See, according to the definitions, cost, cost of capital is the minimum required rate of earnings or cut-off rate of its capital expenditures. Okay, okay, and cost of the capital, a firm is that minimum rate of return which will at least maintain the market value of the shares. Okay, after investment of that amount in the company should generate minimum income. Okay, minimum income. Okay, to pay who provide the amount to the organization. In case if the company not generating minimum income, then it will be leads to the problem. Generally, it comprises three components. Cost of capital is equal to RO plus B plus F. Here K is equal to cost of the capital. RO means normal rate of return at zero risk level without any risk. And B premium per risk, premium per business risk, and premium per financial risk. Okay, a combination of all these three we can call as a cost of the capital. And next, importance of cost of capital. Okay, importance of cost of capital. Suppose for example, with one example we can easily understand the concept of cost of capital. Suppose for example, okay, if company investing 10 crores, the rate of cost of capital is 10%, means company should get minimum 10%. If company is unable to get the minimum 10%, okay, it is not possible to continue in the business. They should get excess than the excess 10, but should not below the 10. And okay, importance of the cost of capital, designing the capital structure. First, for designing capital structure of the company, already I explained in the previous class how the company decide the capital structure. Suppose for example, capital company need 100 crores. Okay, out of 100 crores, how many sources are available? Suppose equity, preference, debentures, and long-term borrowings. Combination of all we can call as a capital structure. Combination of all these four we can call as a capital structure. See, equity giving 50% and preference 20% preference, and debentures 10, and remaining long term 20%, mean total 100%, 100 crores we will collect. See, designing the structure, this structure we have to design. Okay, we need 100 crores and designing the structure. Okay, designing the structure from which sources we can procure the amount to do the business. See, out of 100 crores I'm giving 50% equity, 20% preference, 10% debentures, 10% long term. This is a structure, this is also one of the structure. We can make changes according to our need and our requirement, our preference. Yes, can I give the chance to the equity 30% also? Okay, but total should be 100. Okay, if you are giving 30% to the equity, you have to give the preference to the preference shares, that 30% you can add into the preference shares. Okay, and capital budgeting decisions. See, cost of the capital, why we need to calculate decide, taking the decision about the budgeting decisions. Capital budgeting means thinking about the future. Say if company wants to invest in the future, how to invest, okay, how much returns will become, okay, how much returns will become if company going to make the plan to invest 1000 crores in the upcoming 5 years, means how much rate of interest, how much percentage of cost it is required. These are all we can able to calculate in the capital budgeting decisions. And comparative study sources of comparison, previous to present. Okay, previous to present we can easily compare if we have accurate data regarding to the investments, and evaluation of the financial performance. See, cost of capital can use it to evaluate the financial performance of the capital projects. Okay, such evaluation can be done comparing the actual profitability project undertaken, actual cost capital of the funds raised finance project, and knowledge of the firms expected income, and guessing the risk. If we invest that amount in the business, if we invest that amount in the business, how much risk will be there, okay, how much risk will be company going to get, that also we can able to decide. And financing the and dividend decisions. See, if we procure the, if we are taking out of total capital 100%, 100 crores, so 50 crores taking equity, means taking equity, how much dividend should give after completing the year. Okay, after completing the year, how much rate, how much amount will be go outside if we decide the dividend decision. If if a company take the dividend decision, how much amount will be go outside. Okay, for that purpose also we need to calculate the cost of the capital. See, classification of the cost of the capital. Okay, different points are there: historical cost, future cost. Historical cost means past, previous cost, we can't able to make any change. Okay, and future cost means in the future, cost refers to the expected cost of funds to be raised financing a project. Okay, historical cost help to the predicting the future cost, predicting the future cost, and provide the evaluation of the past performance. And the specific and composite cost. Specific source means such as equity, preference, debentures, retained earning. Composite means capital. Composite capital refers to combined cost of various sources. Combined cost. Okay, composite cost means, composite capital refers means combined cost of various resources. Okay, various resources, in other words, weighted average cost of the capital. Average cost, marginal cost. Okay, average cost of capital refers to the weighted average capital. After giving weights to particular after giving weights to the particular source of capital, we can able to calculate the average, weighted average cost of capital. And explicit and implicit. Okay, explicit cost refers to the discount rate which equates the present value of the cash outflows or value of the investments. Okay, explicit cost capital is the internal rate of return which firm pays procuring the finance. Means what the amount we are taking from outside, we need to pay in rate of interest or dividends to the who provide the amount to the organization, shareholders and debentures. Okay, if the firm procure itself in the organization, not going outside, okay, that is the implicit cost. Means implicit cost means company, if the returns investing, the company returns again reinvesting in the organization. Okay, the shareholders, that amount should, we should have to give to the shareholders. Instead of giving shareholders, we are reinvesting in the organization. By reinvesting, shareholders will be forego to the opportunity cost, that is the implicit cost. And factors determining the firm's capital: general economic conditions. Okay, economic conditions, supply of the capital in the economy, that is also will be decide cost of the capital. Market conditions, market conditions, and in the market significant risk. Suppose for example, if the market conditions are good, if the public have the money, they can invest easily. But in the availability of the funds is not there in the society, no one will be show the interest to invest. If the returns, see, market conditions means if the stocks performing in the stock market in good manner, everyone will be show the interest. But due to the many situations, due to the wars between the outside of the country, that may be affect to the stock market, no one will be show the purchase the share market. If the war will happen between the nations, that first of all it will affect the stock market. Okay, in the stock market share prices will be decrease. Okay, this type of situations will affect the cost of the capital. Operating and financing decisions, how the business will be take the decisions. Okay, how the business will be take the decision, how the company will take okay, how the company will take the operating decisions and financing decisions. How finance decisions means how company utilizing the funds what the procure from the outside, and how that funds are utilized in the organization, how the company declaring the dividend. Okay, how the company paying the rate of interest on debentures, how the company paying to the bankers how the company paying interest rate to the bankers. These are all maybe decide the cost of the capital. Okay, amount of financing, the last factor determining corporation cost funds is the level of financing. Okay, a firm financing a firm as the financing requirements of the firm become larger, means the need of the organization also, need and nature of the business, what business company is doing, what activities companies are doing, that also may be one of the factor affecting the cost of the capital. Okay, different controversies are there in the calculation of the cost of the capital. Okay, controversy regarding dependence of the cost capital upon the method and level of the financing. See see if the company declare dividend, what is the effect on the cost of the capital. Okay, if company declares or not declares, if company declares dividend ratio, dividends to the shareholders. Okay, if it affecting or not, we have to see if the company after declaration of dividends, if it is not affecting or if affecting, then on that basis company should take the decision. Some authors, some economists giving the controversial opinions on the cost of the capital. Some are given if the company declares dividends it will not affect, some are given it will be affect. Okay, and computation of cost of it is difficult, not easy. Okay, it is not easy to calculate the exactly, we can't able to calculate the risk, accurate risk what will be happen in the future. Okay, what, see, future is uncertain, what will be happen in the future we can't able to decide now. So this may be lead to calculation of the cost of the problem, this may be leads to the problem in the calculation of the cost of the capital. And computation of retained earnings and depreciation. Okay, it is also very difficult, not easy. Cost of the retained earning, how can we calculate? Okay, outside factors, outside of the company, what the factors are going on in the market, we have to consider before calculation of the cost of the retained earnings. And future cost and historical cost. Okay, this also will be effect for the calculation of the cost of the capital. And problem of weights, see, giving weights, it is a complex issue. Finance manager has to make the choice between the risk value of each source of funds and make the and market value of the each source of the funds. Okay, this the result will be difficult in each case, it is clear. uh, Assigning the weights is not easy. See, computation of the cost of the capital. First one, cost of specific source of finance, computation of weighted average cost of the capital. First, computation of cost of the specific source of funds. Under that, cost of the debt. Okay, cost of the debt dividing into the two parts: redeemable and irredeemable. Okay, redeemable, irredeemable. Okay, companies may raise debt capital through issue of the debentures or raise the loans from the financial institutions. Okay, all the resources involve a specific rate of interest. Okay, from wherever you take debentures or long term loans or whatever it may be, the debentures can be perpetual, irredeemable or redeemable. Okay, cost of the debt, cost of the debt capital is equal to the interest paid on the debt. Okay, cost of the perpetual irredeemable debt. Okay, see, through one example we can easily calculate. Okay, suppose, see, how can we calculate the cost of the debt? See one example. TCS has 15% irredeemable debentures, 100 each, amount is 10 lakhs. The tax rate is 35%. Determine the debenture cost. Assuming that at par, if 10% premium, 10% discount. Three situations given. Okay, TCS company issuing irredeemable debentures. Redeemable means not irredeemable. Redeemable means after certain duration of the time, the principal amount of debenture holders return back to them. Irredeemable means not giving a return to them. Okay, that amount will be maintained by the company. Okay, not given to the debenture holders. Okay, how can we decide? How can we do? See, according to the formula, cost of the debt before tax, cost of the debt after tax. Cost of the debt before tax means company will be get the benefit if the company pays interest amount to the outsiders, means debenture holders and bankers. Company can have a deduction in the while payment of the tax. Company can show as a can show as a interest, means company will be get the benefit. If the company before payment of the tax, if the company give the interest rate interest after after the payment of the tax, how the company will calculate cost of the debt before the tax, means before company payment of the tax. The formula is, okay, KD is equal to I divided by P or NP into 100. Cost KD means cost of the debt before the tax, and P means I means interest, and P means principal amount on the R face value, and NP means net sale proceeds. See, pre-tax, post-tax, before payment of the tax, after payment of the tax. Face value 15. See, face value interest rate is 15 rupees. Okay, 15%, 100 into 15% divided by 100, then is equal to 15. Interest is 15. Okay, and NP 100. Okay, 15 divided by 100 into 100, then 15% will become. Then coming to the after tax, see, after tax formula, KD is equal to KDA, cost of debt after tax, is equal to I into 1 minus T. 1 minus T means, T means tax. How much tax rate is given? 35% is given. Means 0.35 we need to take. 15 into 1 minus 0.35 divided by 100. Net proceedings only 100 into 100 means 9.75% will become. Means after payment of tax, before payment of the tax, cost of the debt is 15%. After payment of the tax, 9.75, means actual cost for the company 9.75% only. And if company redeem the preference shares at 10%, if the company redeem the 10%, then net proceedings will become 110. How 110? Company redemption redeeming the debentures at the rate of 10% premium. 100 into 10 is equal to 100 into 10% is equal to 10 rupees will come. Net already company issued at 100 rupees, then premium amount 10, then it will become 110. So that the rate of interest is the interest rate is 15 rupees only, but company should pay 110 rupees. Okay, 110 rupees. And then the if we do calculation, 15 divided by 110 into 100, then 13.64 percentage will become. Okay. And same as it is, if we deduct the tax, 8.86 will become. Okay. And discount. Okay. Discount. Okay. If the discount 10% discount, 15 divided by 90, why 90 net proceedings? Company, okay, company giving return back to the investment, on the base of the discount. 10% discount means 10 rupees will be comes under the discount. 16.67% will become here 10.83%. The basic difference between pre-tax and post-tax, only in the pre-tax we are not considering tax percentage rate, and post-tax rate we are considering the tax rate. And next concept, cost of preference share capital. Okay, cost of preference share capital. Preference shares is also one of the shares. Okay. And company needs to pay a fixed percentage of dividends to them. Okay, under the preference share capital. Again here two types are there: cost of redeemable and cost of irredeemable or irredeemable. Okay. Cost of preference share capital, cost of preference share capital with without dividend tax, with dividend tax. Okay, without dividend tax and with dividend tax. See, kp, cost of preference, is equal to d by p. Okay, d by p or d by np. D by p or d by np. D is equal to annual preference dividend. Okay, p proceeds or net proceeds. Okay, and cost of preference share capital with dividend tax. Kp is equal to d into 1 plus dt divided by p. Cost of KDP means cost of preference capital, d annual preference dividend, p proceeds, net proceeds, d1 dt means tax on preference dividend. Just let us see the one example, then we can able to easily understand. A company issues 10,000 preference shares, 10% preference shares of 100 each. Cost of issue is 2 rupees per share. Calculate the cost of preference share capital. If these shares are issued at par, at a premium of 10%, at a discount of 5%. If issued at par, okay, if issued at par, okay, 10,000 into 100, then 1 lakh will become. Okay, 1 lakh will become. And see, KP, cost of preference shares, is equal to 10 lakh, 1 lakh divided by 10 lakhs minus 20,000. Why minus 20,000? Okay, this 2% are the cost of the issue. Okay, from net proceedings we have to deduct 20,000 into 100, then 10.2% will become. See, okay, KP is equal to D by NP. Okay, from NP we are deducting cost of issue. Okay, dividends, how much we need to pay? Percentage, what is the percentage? 10%, 10% preparations means 10 lakhs into 10%, then dividends 1 lakh divided by 10 lakhs minus 20,000 and into 100. 1 lakh divided by 9 lakhs 80,000 into 100. Then how much percentage will become? 10.20 will become. At when issued at par, but issued at a premium of 10%. Okay, issued at a 10% premium. Then very simple. Okay, very simple. Then KP is equal to D divided by NP plus premium minus cost of issue. Okay, same problem. Okay, 1 lakh divided by 10 lakhs plus premium 10% means premium 10% 10,000 minus 20,000. One lakh, 10 lakh, 10,000 minus 20,000. How much will become percentage? 9 into 100, 9.26 will. In case if the premium, if they issued at a premium and discount, okay, if they issue the discount, why coming to the par and premium and discount? In the premium, if the company issued at a par, percentage is 10.0, why in the premium 9.26, okay, why issued at discount rate of percentage is increasing. Issued at par means at what rate we are issuing, that amount we will be received. But coming to the premium, why the rate of percentage is decreased means company getting excess amount, okay, than the actual, so that rate of percentage is decreasing. Why the 10.75% in the discount, in the discount column, why percentage is showing high means company is showing 10 lakhs, but company getting only 9 lakh 80,000 only, means 9 lakh 90,000 means discount, company receiving lesser amount than the par. Means suppose for example, if company issuing 1,000, if company issuing 1,000 preference shares at the rate of 10% discount, means 10% discount, 1,000 into 10 by 100 is equal to then 100 rupees. Only the company will be received 900, but at the payment time company should pay 1,000 rupees. And cost of redeemable, next cost of redeemable preference share capital. Okay, shares that issued at for specific maturity and after certain time of period. Okay, in case if certain time period we mention, that will be comes under the cost of redeemable preference shares. See, according to the one shortcut formulas also given, through that we can easily understand. A company issues 1,000, 10,000, 1,000 preference shares, 7% preference shares. Okay, quantity is 1,000, percentage is 7, rate is 100, each premium 10%. Redeemable after 5 years. Okay, after 5 years. Premium 10% means there is a demand for the company. Okay, there is a demand in the market. If there is no demand, company issues at a discount. Means company collecting amount in the form of the preference shares at the premium basis. Premium basis. See, formula, according to the formula, D is equal to MB, D plus MB minus NP, okay, divided by N, and divided by MV plus NP by 2, okay. D, 7% means 7,000, okay. 7% means 7,000, 1,000 into 100, then 1 lakh. 1 lakh into 7%, then 7,000 will become. Dividend 7,000. Market value 1 lakh. But we are issuing at a premium, na? 1 lakh 10,000. Yes, actual value is 1 lakh. But we are issuing, how much we are receiving? Actually 1 lakh worth preference shares we are issuing, but we are receiving 1 lakh 10,000. 1 lakh 10,000. Okay, 1 lakh 10,000. Concept is very simple. 1 lakh worth preference shares we are issuing, but issuing at the rate of 10% premium. Premium. Okay, means how much amount we will receive? 1 lakh 10,000 we will receive. Okay. Market value is 1 lakh only. Okay, but net proceedings are 1 lakh 10,000. Okay, divided by N means number of years, 5 years. Okay, divided by 5 means number of years, 5. 7,000 plus, just we are substituting amounts in the above formula. 7,000 plus 1 lakh minus 1 lakh 10,000 divided by 5, and divided by 1 lakh divided by, okay, 1 lakh divided by plus 1 lakh 10,000 divided by 2. Why we are dividing by 2? Averaging. Then 7,000 plus minus 2,000 divided by 1 lakh 5,000. Then 4.76 percentage cost of preference shares. Next concept, cost of equity share capital. How can we calculate equity share capital? 5 methods are there. One is dividend capitalization method, earning capitalization method, dividend capitalization plus growth method, bond yield plus while considering risk. Okay, how can we consider the risk in the valuation of the capital, equity share capital? Capital asset pricing model, okay, risk free and risk rate. First coming to the dividend capitalization model. Okay, dividend capitalization model. Okay, dividend capitalization means, how can we calculate? The cost of equity capital is calculated on the basis of the required rate of return in terms of future dividend to be paid equity share. On the basis of the dividends, on the basis of how the company pays the dividend, on that basis we can calculate the cost of the equity. See, with one example we can easily calculate. Okay, okay, a Nisha Limited company currently earning 1 lakh, its current market price share is 100. Okay, and outstanding shares 10,000. Okay, company additional cost. See, through one easy example we can easily understand. Okay, under the dividend capitalization method. Okay, dividend capitalization method. Suppose for example, for share, under dividend capitalization method we can easily calculate. Suppose for example, if company issuing the for share market share of the market share price is 100. The dividend paying 8 rupees. Then how can we calculate cost of equity is equal to 8 divided by 100 is equal to 0.08 or 8%. Means how much company paying dividend? 8 rupees paying. Means dividend model. Okay, dividend capitalization approach. means how much company paying dividend to the equity shareholders. On that basis we can calculate. Means market price is 100 rupees per share, company paying dividend percentage, company paying 8 rupees per share, means dividend divided by market value of the shares into 100, we can able to calculate the share price, we can able to calculate the equity cost by following this formula. Next, earning capitalization model. Next, earning capitalization model based on the company earnings. If we capitalize the company earnings, we can able to calculate the percentage of the equity. See, suppose for example, okay, earning capitalization means we are capitalizing the company earnings. Suppose for example, okay, EPS, okay, per earning per share is equal to, okay, earning per share is equal to 15 rupees, and market price is 150. Then cost of equity is equal to 15 divided by 150, 0.10 is equal to 10%. Means what we are doing here, the company earnings we are capitalizing. Through that we can also calculate the earning capitalization method. Okay, earning capitalization model approach. Cost of equity is the discount rate that equates the present value of the expected future earnings per share net proceedings of the sale of the share. Means in simple format, we can understand the earnings capitalization model. Company earnings we are capitalizing, based on that we are calculating the cost of the equity. And next, dividend capitalization and growth model. Okay, the growth rate approach. Okay, see the formula for the this method for the dividend, for the dividend capitalization plus growth rate, dividend capitalization plus growth rate. Okay, formula KE is equal to D by P plus growth. Okay, suppose for example, dividend is equal to 6 rupees, market price of the share, 60, growth rate of 5%. How can we calculate under according to the above method? Simple, KE is equal to 6 by 60 plus growth rate 5 percentage. Okay, then 10 plus 5 percentage, 15 percentage will be come. Means not only dividend yield, not only dividend capitalization, on the base of the how much future returns will become. Growth rate approach means how much growth will be there in the future also we are considering. Present paying 10%, but in the future also 5% will become. Then 10 plus 5% is equal to 15% cost of the equity. Okay, and next, bond yield plus risk premium. Okay, bond yield plus risk premium also we can calculate by following one of the formula. Okay, bond rate and KE, cost of equity, is equal to, under this model, bond yield plus risk premium. Suppose for example, if a bond yield is 9%, risk premium is 4%, then it will become 13%. Means how much bond will be, how much bond giving yield plus risk we are also adding. Means if the investor, see, yield of long term bonds plus risk premium, means yield of the long term means certain percentage will be given by the, certain percentage it also give, but we are, for that we are adding risk premium. Means by taking investment, by putting investment in the company, how much investor taking risk, Okay, that also we are calculating. Yield of long term bonds plus risk premium. Okay, see, yield of bond long term bonds is 12% plus risk premium is 3%, then is equal to, it will become 15%. Okay, a company is planning to sell equity shares to Mr. A, planning to invest in the company equity shares, bond yield 12%. An investor is investing, calculate this required rate of return is equity 3%. 3% risk premium will be there. Means 12% plus 3% is equal to 15% will become. And cost of retail earnings means, cost of retail earnings means, if the company out of its profits certain proceeds, certain amount reinvesting in the business, certain amount reinvesting, means after meeting all expenses, after payment to the all shareholders or all members, after payment debenture interest, bank term loans interest, all. Okay, sometimes company reinvest certain portion of amount in the company. Okay, for that how can we calculate the retail cost of retail earnings? See, company cost of equity share capital 15%. Okay, and KE into 1 minus T into 1 minus B. Okay, brokerage, B means brokerage charges, T means tax rate, 15%, 1 minus 40% tax rate, and 0.0 brokerage charges. Okay, 15% into 1 minus 0.40 into 1 minus 0.2, 0.02, then 8.82% will become. Cost of retail earnings means, or other type also we can understand. Instead of giving dividends to the shareholders, if the company reinvest that amount into the organization or in the company, what is the rate of the that retained earnings? And weighted average of the cost of the capital. Weighted average of the cost of the cost of the capital means combination of all capital, all forms of the capital. Okay, combination of the all forms of the capital means equity, preference, debentures, long term loans, borrowings. See, under that how can we calculate? Cost of weighted average capital is equal to sigma xw divided by sigma w. Okay, kw is equal to weighted average of the cost of the capital, and x is equal to cost of specific source of finance, w x into w, sigma x into w, w is equal to weight or proportion of specific source of finance. Okay, through above formula we can easily calculate weighted average cost of the capital. What are the advantages are there? Calculation of weights is simple. Book values provide a base. Book values are easily available. We can easily calculate without any. And next thing, limitations also there. There is no relation between book values, present economic values of the various sources of capital. And see, through one example we can easily understand the weighted average cost of the capital concept. See, uh, Indigo Limited supplied the following information to you and request the compute the cost of the capital based on the book value. See, based on the formula, based on the above formula, what is the formula? Kw is equal to sigma x into w divided by sigma w. By applying this formula, we can easily calculate the weighted average cost. Equity capital, in suppose one Indigo company name is Indigo Limited. Equity capital 1 lakh, 10 lakhs, long term debt 8 lakhs, short term debt 2 lakhs. Market value 15 lakhs, 75,000, 7 lakh 50,000, 2 lakhs. Individual we have to calculate based on, first of all we have to calculate based on the book values. Equity capital 10 lakhs. How we are giving weights to the 0.50? Okay, 10 lakhs divided by 20 lakhs. Then into 100, then is equal to 0.50 will become. Okay, out of 20 lakhs, equity capital is, out of 20 lakhs, equity capital is 10 lakhs, means 50% is the equity capital. And 40%, how 40 how 0.40 will become? 8 lakhs divided by 20 lakhs into 100, then 0.40 will become. And 2 lakhs divided by 20 lakhs into 100 is equal to 0.10. Overall 1. Okay, this weights we have to multiply with the specific cost. Okay, specific cost is for 12%, 7%, 4%, 0.50 into 12, then 0.60 will become 0.40 into 7 into, and 0.10 into 0.4, then 0.4 will become total weighted average cost of the capital 9.2. Total weighted average cost of the capital 9.2. Okay, this is the way we have to calculate the weighted average cost of the capital. And next concept, marginal cost of the capital. Okay, companies may raise additional funds from expansion. Company may raise, marginal means additional, marginal means additional. Okay, additional cost means whenever the company for raise the additional funds for expansion, hence financier may be required to calculate the cost of the additional funds to be raised, means how much cost is incurring for the raising the additional cost. And the cost of the additional funds is called marginal cost of the capital. The weighted average cost of the capital, new incremental cost, known as marginal cost, means if we procure additional amount in the form of the capital, on that also we need to calculate the cost of the capital. Okay, this will become marginal additional cost of marginal additional cost. Okay, okay, thank you. We will meet in the next class.